Yeah, the market's barely moving here. S&P's down 0.5%, Nasdaq's up 0.25%. Clearly, stocks have discounted this very bad news on the economy. But what's in the market as far as whether or not these jobs come back and how quickly the economy recovers?
That's what the stock market is trying to discount because, I think there are three waves to this crisis. We've had the COVID case crisis, and now we have that first wave of social distance company victims, and now we're going to see how all the asset owners react. So there's a lot of information to discount. But I think it's good news that we are getting just awful data, and the stock market, unlike early March, it's not in a free fall. So I think the market is starting to look through this and think, 2020 earnings are kind of a write-off. And even if it's a slow recovery, stocks generally recover almost 12 months before GDP recovers. So I think what we're seeing is a pretty typical sort of bottoming of the market and kind of a revival.
Tom, I know you've had some particularly good and timely calls lately when it comes to the recent action. Just bring us up to speed on where you are, what your performance has been, and what you're calling for now.
Yeah, I don't think we can give ourselves, great marks for this because it's really been so hard to adjust to what's happening, and because this pandemic is moving so quickly. But I think what's been really, really notable is we recovered 2,800 on the S&P, which is a 50% retracement. And since 1929, there have been 10 declines of over 30%. Whenever you recovered that sort of halfway mark, 50% of losses, you don't make a new low. So I do think the stock market has really bottomed. I'm saying this realizing there's a lot of uncertainty out there. And I think logic says, look, there's so much bad news ahead. How can the stock market be looking ahead? And I think part of it is that the policymakers did a really good job of really acting quickly. And we know the central banks have intervened and really supported markets in a way that's providing liquidity and dampening volatility. So I think that's why, I know it sounds strange, but we are really in a bull market. And I think recovering that 2,800 is a big deal because I don't think we revisit 2,200.
It sounds strange and it's out of consensus. Mona, what do you think about that call? Just if you're keeping track, S&P is down 18% from the highs, which is technically out of that bear market phase and a lot better than where we looked in March.
Absolutely. Look, we're down 14% year to date. As Tom alluded to, we rebounded about 24% now off the lows, retraced nearly 50% of the losses in March. That being said, we do think some of this may have come too far, too fast. We really were driven by, one, the virus and the health issues perhaps stabilizing here, which is good news. The stimulus from both the Fed and the fiscal broadly being quite strong, quite fast. I think that's another piece of good news. But at this point, to us, the risk reward doesn't seem nearly as compelling. We're facing some key unknowns ahead of us. What does the reopening of the economy look like, especially now with an unemployment rate close to 18% after this morning's jobless claims numbers? And a consumer that's really quite cautious still. Keep in mind, this U.S. economy is driven by consumption and the U.S. consumer. Now, we do see a bottoming process ahead of us, perhaps sometime between now and the June timeframe. Where we agree with Tom is that we may not retest the lows, given the nature of the stimulus that's been nearly 40% of GDP here in the U.S. But we do think key levels to watch here are that 2,500 and 2,400 in the S&P. So about 10 to 15% perhaps downside. But we do continue to believe that this type of retest does provide opportunities. How do you position in sectors that we see really thriving in a post-COVID-19 world? So that's how we're looking at it more broadly.
What are the recommendations there?
Yeah, absolutely.
Yeah, no, give us your maybe top three picks.
Sure. So, again, we always talk about that barbell approach. On one hand of that barbell, we continue to like defensive asset classes, treasuries, gold, high quality IG. But that really post-COVID positioning includes things like the rise of food delivery services and online retail, technology trends, so I'll name 5G, cloud computing, cybersecurity, especially for companies looking at a more work-from-home workforce, and then really fundamental shifts in the healthcare space, so telemedicine, pharmaceuticals, trends towards testing equipment and devices in an on-demand fashion. we're really starting to see interesting positioning, and we're seeing some of that reflected already in the S&P with tech and healthcare, two of the outperformers thus far. So we continue to feel like while we will get a bottoming process, there are ways to position yourself to outperform and really benefit from this.